All right, hello everyone. We'll wait just a moment for a few others to join. Okay, so hello everyone. Welcome to the North Hartford Promise Zones Filing Your Taxes 2021 virtual event. This event is going to be running from 6 to 7 p.m. today, February 11th, and it's the first event of our winter virtual series. If you would like to join us at our upcoming virtual events, COVID-19, The Facts on February 18th, and Emergency Housing Resources on February 25th, both of those will also run from 6 to 7 p.m. Please be sure to fill out our Eventbrite invitation to attend those on Zoom, and the link to both of those events are going to be posted in the chat now. Also, please be sure to follow the North Hartford Promise Zone's Facebook, Twitter, and Instagram for more information on these events, as well as others. And the links to all of our social media are also going to be posted in the chat now as well. The NHPZ Winter Virtual Event Series is a follow-up to our Fall Virtual Event Series, and if you missed those are going to be posted, or those are posted on the North Hartford Promise Zone's Facebook page, and you'll be able to see all of the recorded videos from our last series, and the link to our previous videos are going to be posted in the chat at the end of our event. So our Filing Your Taxes 2021 virtual event today, we have Laura O'Keefe from The Village. Feel free to go to the next slide so we can see your information. And if you have any questions for the speaker, feel free to ask questions in the Zoom chat or in the Facebook comments, which are going to be monitored at any time. And we'll be sure to address those during our Q&A session later today. So Laura, you can begin whenever you're ready.
Okay, thank you so much. Thanks for joining me this evening. I really appreciate the time. And tonight what we're going to talk about is basically tax filing season for this year. It's going to be an interesting one as this is obviously in the middle of the pandemic, but I wanted to provide some pretty basic information, sort of that structural information with regard to just understanding how your taxes are prepared, what they mean, and just those basic building blocks of a quality return. Just a little bit about the Village to start off with. So I am the director of the Financial Opportunity Center with the Village. The Village has been around for more than 200 years and primarily focuses on behavioral and mental health services. So where the Financial Opportunity Center fits into that is really about the reduction of stress that comes with financial insecurity. And so our department really focuses on those key elements that are tied to financial insecurity. And so we focus on financial coaching, career coaching, income supports, and also what we're going to talk about this evening, which is tax preparation and tax filing. So to start us off, we're going to talk about why tax training is important and why this information is key. So it's basically just to know the core components of your tax return, to understand what the EITC or Earned Income Tax Credit is and why it's important, and to hear about ways to save a portion of your Earned Income Tax Credit for the future. So those are sort of the key things that I want people to take away from this evening. Again, if you do have questions, please feel free to ask them in the chat, or if you have questions, please feel free to answer them. I will be providing a lot of information this evening, so it's a lot to digest, and there probably will be questions. So please think about those as we move through the presentation. Okay. So how is the bottom line determined? And one of the things that is so important for us in VITA, volunteer income tax assistance, is not only doing a tax return for somebody and helping them through that process, but we want people to understand how the bottom line is determined. How do they get to refund owed or getting a refund back? So essentially what happens is that your total income is added together. So we have earned income, and then we have unearned income that is going to be added together. Then we're going to move into taxable income. So this is going to be your income that they look at after your adjustments are taken into consideration, your deductions, and your exemptions. Okay, and then we're going to have a total number there. Then we're going to move to what your tax liability is, or what they determine you owe based upon your taxable income. And then we're going to factor in the tax credits. And this is where that EITC, or earned income tax credit, comes into play that we were talking about before, among other tax credits and exemptions that we're going to factor in, which ultimately leads to the amount owed or the refund due to the taxpayer. So we just like people to have sort of a basic understanding of how the math works, and how they get to the eventual, again, amount due or refunded amount to the tax filer. Okay, so the basics of tax preparation really start with these two factors. Whoops, excuse me. Which is going to be your filing status and the dependents that you claim on your tax return. So we're going to start with filing status. Again, these two pieces are sort of the building blocks on which the return is built. And then the rest of the return's accuracy will depend on these two pieces. So I really like people to have information about these two things. So filing status, there are actually 5 filing statuses. The first one is single. We have married filing joint, married filing separately, head of household, and the one that most people do not know or are less familiar with is the qualifying widower. So this determination, again, is critical to the accuracy of the taxpayer's return. All right, so we're going to go into sort of the definitions of what these are. So as of December 31st, and each tax year is unique. Okay, so every tax year you're going to sort of reassess your situation, what it is at that moment, and that tax return is going to be based on that information. As an example, in 2019, you might be single. In 2020, you might get married. So that's going to change the filing status for that particular year. So as of December 31st, was your taxpayer or is your taxpayer single? And what this means is you are not married, you are divorced or legally separated. And one of the things that I want to emphasize throughout this presentation is you're going to see things like words like legally separated. And what I want everyone to understand is that this is about tax law. Okay, so there are requirements, there are pieces that need to be adhered to with regard to applying the law to your particular tax situation. So when we say divorced or legally separated, it is indeed legally separated, not just someone moves out of a house, and that legal separation is not final. Okay, so just keep those pieces in mind as we move forward. There's also widowed, obviously, which is going to be that your spouse passed away in either 2018 or 2019, and the taxpayer did not remarry before the end of 2020. All right. The next filing status is also one that people are quite familiar with, which is married filing jointly. So this is going to be married spouses living together and agree to file a joint return, married and live apart, but are not legally separated. So at this point, you can still and should be filing a married status if you are not divorced or legally separated. We can also look at separated under a not final divorce decree. Okay. And or your spouse has passed away or died during the year and the taxpayer has not remarried, in which case you go up to the widowed status. Okay, additional considerations. So if your spouse has passed during the tax year and the taxpayer has not remarried, they are considered married for the entire year. Okay, so we do give that consideration to a tax filer. So if someone passes in 2020, for that tax year, they can take that joint status for that tax year. Now in 2021, for next year's tax return, that will change. The surviving spouse is eligible to file as married filing jointly or married filing separately, whichever they choose. And then the surviving spouses that remarry must file with a new spouse as either married filing jointly or married filing separately. The deceased spouse's filing status becomes married filing separately. Okay. Okay, so our next status is going to be married filing separately. In this situation, there are reasons typically that people will choose to select this status. So the married filing separately status is really about separating out the income from one another. So, and the reason that somebody may want to do this is because of debts, usually. So if someone owes back child support, back taxes, back student loans, anything federal or state where those entities can actually garnish wages or take a tax refund, that is where someone may want to file as a married filing separately status. So that situation, there's actually a workaround for it because the better status is actually married filing jointly, at least financially for filers. So if you can do married filing jointly, there is a way, and it's called the injured spouse form, that you can actually file as a joint filer, but then protect what we call the injured spouse's refund in that situation. So we would take a percentage, the government would take a percentage of that to address the debt, and then leave the spouse who is not responsible for that debt, leave their refund intact. Okay, so if one spouse itemizes in this situation, the other spouse must also do itemized deductions. Okay, so this is a situation where if someone owns a home and they're going to be itemizing and they do a married filing status, the person that has moved out of the house and may be living in an apartment or another situation, they would also have to itemize as if they have a house. So it's not the most optimal status that's out there, that's for sure. So again, if people can and are willing to do married filing jointly as a status, that's the preferable status, and then using an injured spouse where necessary. Okay, and this gets into some of those reasons why people might want to file a separate return. Okay, our next status is head of household. So the taxpayer is eligible for head of household status only with respect to a qualifying child or a qualifying relative. Okay, so taxpayers must be unmarried on the last day of the year. Or meet the test for married persons living apart with dependent children. The other factor is that the taxpayer must not have paid more than half of the cost, must have paid more than half of the cost of keeping up a home that was the main home for this person, the qualifying child or the qualifying relative, for more than half of that tax year. Okay, so what we want to see here is that we have people who are either divorced, legally separated, situations like this in order to file as head of household. If you are a married person, you cannot file as head of household. You must file as married filing separately or married filing jointly. Okay, so the only way to get around that rule if you are married is something that is called abandonment. And I'll talk a little bit about that. So if someone if a married person, if the spouse leaves the household, and it has to be for the last 6 full months of the calendar year. So it would have to be from the summer, from July all the way through the end of the year. Okay, and not return. So it's not one of these situations where someone leaves and then they come back and then they leave and then come back and like that. It would need to be leave and then stay, away from the situation or out of the household beyond the 6 months. If that happens, then if there are children in the household, a person could then file as head of household. But that's the only situation in which a married person could file for this particular status. Okay. So even if a custodial parent has given up the right to claim the dependency of that child, they can file head of household using that child as their qualifying person. Non-custodial parents can never claim the head of household filing status. Okay. All right. Qualifying widower with dependent child. This particular status is with regard to someone who has lost a spouse but is continuing to raise children. So in this case, what they will do, the IRS, is they will allow someone to file as a married filing joint status for 2 years beyond the person's passing. So if someone died in 2018 or 2019 and the taxpayer did not remarry in 2020, then they can take this particular status. Okay, and it just allows them to get a higher, what we call standard deduction for those 2 years, Once those 2 years are over, then the person would resort to whatever filing status they were at that given time for that year. So if they've remarried after that point in time, they would do a married filing separate, married filing joint status, pick between the two, or they would file as single, and so on and so forth. Okay. And this goes into what we were just talking about. If the spouse dies during the current tax year, married filing jointly. If the spouse died and one person, if the spouse died during one of the 2 preceding tax years and the taxpayer has a qualifying child, then they would be the qualifying widower. All other statuses of people that are single with kids would either be single with a dependent child or head of household. Okay. At this point in time, I would like to just offer it up to any questions that the group might have, just because that was a lot of information. And if not, then we will move into dependents. So I will just leave it for just a moment to see if there are any questions following that. And Jenna and Anika, are you guys following the chat to let me know?
Yes, I'm watching. Right now, we don't have any questions in the chat, but I was
Okay.
wondering personally if you
Yes.
could talk a little bit more about the benefits of filing jointly over married filing separately.
Right. So as a married filing joint filer, that is the highest level of what we call standard deduction. So when you file your taxes, you have your income, and then the government applies what they call either standard deduction or itemized deductions. The standard deduction is for most people. Itemized deductions is where you get into a situation where that amount of money, and it's basically all the deductions that you could take, particularly for like home ownership. So if you own a house and you have property taxes and mortgage insurance and all of those kinds of pieces, and then you add in any miscellaneous deductions or charitable contributions or things of that nature, if those things all added up together were to equal more than the standard deduction, then you would choose the higher of the two. So you would either choose the standard deduction or you would choose itemized deductions. The IRS is funny, and I always like to equate it to going to a cocktail party. So if you go to a cocktail party and you take a chip and you stick it in dip and you take a bite, you only do that once, right? Because doing that more than once and using the same chip after you stuck it in your mouth is a little bit on the gross side. So we don't want to do that. The IRS feels the same way about double dipping into deductions or credits and things of that nature. So when you have the option, you're going to only pick the one that is better suited to your situation. So for most people, that is the standard deductions, particularly after when President Trump was in office, he actually increased the standard deduction quite a bit. In fact, it was close to double of what it was before. So a lot of individual filers moved over to using the standard deduction as opposed to using itemized deductions. So for standard deduction, the highest level of that is for joint filers. And then we have the one for the married filing separately filers, which is actually lower. So you're better off if you can. And I understand, and we understand that not everybody can file a joint return. There might be an estranged spouse. There might be a situation where people aren't speaking anymore, things of that nature, in which case you wouldn't file a joint return with your spouse. But if it's at all possible and you are married, the joint filing is better. I hope that answers your question.
Yeah, thank you. That clarifies it a lot.
Great.
I don't see any other questions, but we can give a little bit of time. Up to you.
Okay. Okay, so if there aren't any other ones, and we can save them to the end if that makes sense as well, I will move into dependents. So dependents are going to be the individuals that you are putting on your tax return, people that you are claiming. And this also gets really, really confusing for people at times. So it's a really good thing to talk about. All right, so qualifying children. And of course, the IRS makes this very complicated by having multiple ages of what is qualified to be a child. So let's get into all of that. The other thing that I want to point out with a lot of tax law is that the IRS requires you to meet all of the standards, not 1, 2, or 3 of the standards, but all of them simultaneously. Okay, so when we're talking about these, it's not just that somebody meets residency and we're okay, or that they meet age and we're okay. They have to meet relationship, age, and residency in order to qualify as someone's qualifying child. So the thing that I say sometimes is, just because Jimmy from down the street comes and eats at your house every night doesn't make him your qualifying child. Okay, so it really is meeting all of these tests. So the first test is going to be relationship, and that is going to be a blood or marital relationship. So, we're talking the things that all make sense to people: son, daughter, potentially grandchild if they're living with a grandparent, things, those sort of relationships that we know. It's going to be age, and this is where it gets a little complicated because there's multiple ages. So there's going to be under age 19. So that's going to be, all of the sort of young children, right? Or they can be under 24 years of age and a full-time student. So that's an important clarification. Under 24, but they also have to be a full-time student in order for that to qualify. Or they can be any age at all if they are permanently and totally disabled. Okay, so those are the ages that qualify for qualifying children. Any one of those would qualify. Children have to be younger than the taxpayer. And one of the things that I like to say about this is that, these rules came into being because these rules at one point in time, throughout the United States were broken. Okay, so this one about the child being younger than the taxpayer is a really interesting one, because it seems as though that they had to put that in there because people were trying to claim people as children that were older than them. So that's sort of an interesting piece of tax law, but they have to be younger than the taxpayer in order to be a qualifying child. And the dependent cannot provide more than half of their own financial support for the year. Okay, so if they have a position, a job, and they're making, a decent amount of money, they live in your house, but they are paying for their own rent, they're paying for their own food, they're paying for their own transportation, and so on and so forth, essentially covering half of the expenses of their life, then they cannot be considered a dependent or a qualifying child. So just an important clarification. Okay, and then the last piece of this is residency. Okay, so the child must have lived with the taxpayer for more than half of the year. Okay, and if the child meets the tests to be the qualifying child of more than one person, so this would potentially be for divorce decrees or children that have parents living in 2 different places. If that happens to be the case and these things are equal among those 2 taxpayers, then basically there's what we call a tiebreaker rule, where the person that has the higher level of income in that scenario would actually take the person as the qualifying child. Okay, so helpful acronym with this is SARA. Okay, so again, we're talking about support. All right, so more than half, you're providing more than half of the person's support. Those 3 age groups, okay, are one of those are met. Those relationships of marital or blood relationships are held. And the residency piece, okay, which is they must live with you for more than half the year in order to be claimed as your qualifying child. And then, of course, the all rule. They have to meet all of those tests in order to be your qualifying child. Okay, so here's the second type of relationship, which is called a qualifying relative, a little bit different. Again, people must meet all of these tests in order to qualify as a qualifying relative. So they have to have either relationship or they have to be a member of the household. Okay, so the relationship to start with is going to be someone who is blood or marital, okay? If they are blood or marital, they do not necessarily need to be a member of your household. So let me break that down for a second. If so, my sister, as an example, lives in Massachusetts. Okay. She's my blood relationship. If her gross income was less than $4,300, she's not the qualifying child or a qualifying relative of someone else who might claim her on their taxes, and I provided more than half of her support during the tax year, then I can claim my sister, even though she doesn't live with me, as my qualifying relative. Okay. And that is true because of this relationship part of this particular test. Okay. Now, there's the other side of this, which is called member of the household. This would be people who are not blood and who are not marital. So let's say that I have a boyfriend living in my house. Okay, we're not married and there's no blood relationship there. If that is the case, then they would have to live with me, the boyfriend in this case, would need to live with me all year as a member of my household in order for that to count. So AKA, if it's a boyfriend, they can't live in Massachusetts. Only my blood or marital relationships can do that. Okay, so that would be living in my house, but I could potentially claim him if the rest of these tests were true. So he is a member of my household all year. The gross income for him is less than $4,300. He's not being claimed by anyone else, parents, grandparents, anybody else in his life. And I provide more than half of his financial support. Okay, so if those pieces are true, he can be my qualifying relative. Okay. All right. All right. So let's get into a little bit about EIC or EITC. Those things are the same thing. Earned income tax credit, earned income credit. They're exactly the same. Okay. So this credit is very, very important to families that we serve at the village, in that this credit can be worth up to 10% of a family's adjusted gross income for the year. So this is very impactful. So if people are eligible for this particular credit, we want to help them access that credit. And we do that at the village and with our partnership and our campaign through offering VITA, which is the Volunteer Income Tax Assistance Program. And I'm going to talk a little bit more about that as we move into the presentation a little further. And then I'll have some information at the end about how to access VITA for this year. So this piece here is about who qualifies for VITA and what rules you have to abide by in order to receive the earned income tax credit. So for everyone, there are just a certain sort of overarching rules to qualifying. So let's start with that first column. So taxpayers and qualifying children must all have social security numbers that are valid for employment by the due date of the return. Okay, so when we're filing, whether that's in the current year, typical year, January to April, or if an extension is filed, they would have to have a social security number that is valid, everyone on the return, in order to qualify. You cannot be married filing separately. Okay, the government sort of has, it's an interesting status for the government, because again, it has to do with usually with someone having a debt that they need to pay. And it's not the most favorable filing status with the IRS. So there are some sort of things about it like this, where they say, we're not sure about providing earned income tax credit in that situation. So they are not going to allow it in the married filing separately status. And that's where filing jointly with the injured spouse can come in handy, especially when people have children. Okay, we have to have U.S. citizenship or resident alien all year, status all year. Filers cannot file a Form 2555. This relates to foreign income. Their investment income has to be less than $3,600, and you cannot be the qualifying child of another person. Okay, so you have to be filing in your own right. Okay, so that's the rules for everybody. If you have qualifying children in the mix for the earned income tax credit, that's going to be the column in the middle. So that is going to be relationship, residency, rules that need to be filed in order to qualify for the credit. So children must meet relationship, age, and residency. Now, something to note about this particular credit, and this is really the only one where this applies, is that there is no support test here. So if a child was making some money and providing their own support, but they lived in the household and were being claimed by those parents, it would not impact this credit. It does impact other things, but it does not impact the earned income tax credit. In this situation, the qualifying child cannot be used by more than one individual. So again, if we do have divorced or separated parents or parents that were never married, only one person can be claiming, one taxpayer rather, can be claiming the EITC. Okay, and then the taxpayer cannot be the qualifying child of another person. Okay, and then finally, over on the far side here, we have Part C. It's a very common misconception that people have to have kids in order to get the earned income tax credit, and that is not true. You can actually be between the ages of 25 and 65 as of December 31st to get earned income tax credit. These other rules will apply. So you cannot be the dependent of another person. You must have lived in the United States for more than half the year, and you can't be the qualifying child of another person. The credit for people without children is going to be smaller than the credit for people with children, but there is still a possibility that some earned income tax credit can be obtained if people qualify and meet these rules. Okay, so this just talks about what we were talking about before in terms of what needs to apply. That would be the middle column there for earned income tax credit. So again, it's going to be relationship. These are some of the relationships that do fall into that category. So son, daughter, stepson, stepdaughter, or a descendant of any of these individuals. A brother, a sister, stepbrother, stepsister, or a descendant of any of those, or an eligible foster child. And this would be a child that is placed by an organization, Department of Family and Children, so on and so forth, with an eligible family. Okay. So then we have the ages. Again, those same ages apply. Under 19 at the end of the tax year, under 24 and a full-time student, or permanently and totally disabled, and any age at all. And then the residency rule. So lived with the taxpayer in the United States for more than half of the tax year, which is 183 days. And temporary school absences do apply. So if they are the 24 category and a full-time student, those temporary leaves when kids are living on campus, that's totally fine. Okay. This is actually a visual of the credit, and I really like this because I think it just brings the credit to life and sort of explains, what it is at the end of the day. So the EITC credit actually was brought into being in the 1970s, and it was first originated under Richard Nixon's administration, and then moved into President Ford, and then was actually expanded by President Reagan. And these were all pieces of getting individuals back to work. And this credit has actually been deemed one of the, if not the most successful anti-poverty programs in the United States, and the most pro-jobs program in the United States. I believe President Reagan was actually the person that said that. So this is the visual, and it's basically on a bell curve. So if you follow from the far, where I'm looking at it, left-hand side, basically, if you have zero earned income, okay, there's going to be zero credit. And this ties in with the name, right? It's called the earned income tax credit or earned income credit. So there has to be earnings in order to actually qualify for the credit initially. All right, so if you're on the far left-hand side, or at least the screen I'm looking at, there would be zero credit. But as you move up the side of our bell here, you're going to increase in credit. And the things that impact this particular bell is going to be your filing status, the level of income that you have, and the number of dependents that you're claiming or qualifying children. Okay, so this is going to be going up, 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 up until you reach the top of the bell. Now, at the top of the bell, in order to qualify for the $6,660 $6,660 of credit that's up there, not everybody is going to get that level of EITC. The person that's going to be qualified for that is the person that's going to be between the $14,800 and the $19,330 at the bottom, which is our income line. They have 3 or more children and they are married filing jointly. So that's sort of that category where we're going to get to the highest level of credit. That does not mean, though, that the people that are not in those categories don't get any credit. They will. It will just be along the bell, okay, depending upon where the income is, where the number of children falls, and what their filing status is. Okay, so usually I just like this one because it's a good sort of visual representation of how the credit goes. And essentially, again, it was in order to help people get back to work. So you're starting to get earned income, you join the bell curve, right? And then as your income goes up, you're joining, you're getting more and more and more credit. Then you're back to the other side. This means more income on the other side of the credit until you cap out at a point where you are not eligible for that credit anymore, because you're at a point at which you are able to self-sustain. And that was really the idea of the credit. Okay. EITC and ACEs. So what is the connection? So in many of our communities, in Hartford and certainly all over the country, there are communities that experience high levels of adverse childhood experiences, or ACEs, which are potentially traumatic events that occur in childhood. ACEs can include violence, abuse, growing up within a family that experiences mental health, substance abuse, and so on and so forth. So where does EITC fall into this? Well, EITC is a credit that actually helps with, again, increasing people's income. It links to lifting children specifically out of poverty each and every year. And as I had mentioned earlier in the conversation, it's really can be worth up to 10% of a family's adjusted gross income. So if we can help people to really harness the power of earned income tax credit, really harness the timing of VITA and of the tax season to help people think about how they're going to use their tax refunds to save, and to really think about, what would I really like to do with these dollars? How would I like to propel myself and my family forward financially, and really contribute to overall financial stability for the entire household by harnessing the power of our tax refunds, and specifically this earned income tax credit. So that's really what, how these two pieces connect. And something that we really try to do in VITA is really say, listen, we understand that there will be some of these dollars that you need to spend. We all need to buy gas for our cars and groceries and pay for our childcare and do all of those very necessary things. But how can we pull even just a little bit of EITC or a little bit of tax refund to think about how we can use that to apply to our future financial stability, if that makes sense. Okay, so here's some of those pieces. We really want to contribute to decreasing any risk factors related to ACEs and increase any protective factors that are related to ACEs. So utilizing EITC to help families meet basic needs such as housing and food, erasing the stress, or at least easing the stress of financial burdens that people have. Establishing a savings cushion to weather financial emergencies. And certainly there was no bigger financial emergency than what has been happening this year with COVID and all of the job loss that has resulted from that and things like that. Savings is so key. And I'm a huge proponent of starting small, starting wherever it is that you are, and moving slowly and surely up from there in terms of what you're able to put aside. And then when connected to financial coaching, which the Village actually offers free of charge, we can actually then link to strengthening core life skills, including financial planning, and increasing the overall outlook for parents and caregivers through just general confidence building. When you have control over your finances, that's a powerful thing. You feel powerful when you do that. And really connecting people to their dreams and their goals for the future. And that's really what we want to help people do, is really think about, what is it that I want? out of my life? And how can I use these opportunities, like receiving a tax refund or receiving EITC, to help me propel my family and myself forward? Okay, so next steps. How does one access the earned income tax credit? How do I access tax preparation? And the way that we do it at the Village, and with our partnership with United Way of Central and Northeastern Connecticut, and with HRA of New Britain, and our many, many fabulous partners that we work with in VITA, is offering tax preparation services free of charge to filers. So we want people to hang on to as much of their money as they can. If you don't have to pay for tax preparation services, please don't. Access them for free. We offer it. It's a requirement of all of us. I have a very, very small staff, but they're mighty. And we work with a lot of volunteers. So in a typical year, we have anywhere from 250 to 300 volunteers that work in this program. And they are certified, trained and certified with the Internal Revenue Service every single year. We have to retest every single year in order to work in this program. So it's safe, it's quality tax preparation, and we will help people that earn up to $57,000 or less a year to access free tax preparation services. Now, this year, with COVID-19 and trying to keeping people safe, tax filers, but also our staff and volunteers, we are offering tax preparation virtually. So we're doing it all online, and it is easy and it is safe. And to get more information, people just need to visit 211ct.org /tax help. And there's going to be the information that you see below that bullet when you get to that web page. So you're going to see the link for Central and Northeastern Connecticut. Our catchment area is the greater Hartford area, Tolland and Windham counties. So anywhere within that stretch, we will serve with our particular link, which is the one listed there in the green lettering. And then we also, again, partner with HRA New Britain, and their coalition actually helps with Bristol, Farmington, Meriden, New Britain, Plymouth, Southington, and Wallingford. So we have a lot of the state covered with our two coalitions, and we are both offering services virtually. So wanted to let everybody know about that. All right, so that is the end of the presentation, but I'm perfectly happy to accept any questions, to have a dialogue at this point. So I don't know if Jenna or Anika, if you have any questions in the chat, or if you want to unmute anybody.
Yeah, thank you all so much for coming to this webinar, and thank you, Laura, for such an amazing presentation. I learned a lot, and I hope everyone who came learned a lot too. We have quite a few questions coming in the chat.
Okay.
So I'll read some of them, but I also want to say, for those of you watching the recording, my email is up here on the screen now. And if you have questions for later, feel free to email me and I will forward them to Laura for the future.
Sure.
So one question that we have in the chat is, what documents should I bring to my VITA appointment? And I think that sort of speaks to some questions about what does the process of actually getting VITA services look like this year, especially virtually. So
yes,
that.
Right. And so, yes, and to answer your question, so it's like bring them, right? So what we're actually doing is we're going to have people upload documents. So, and this can be done either on a mobile phone, a cellular phone, or it can be done via computer or tablet. So whatever people have, then we can actually get access to those documents. So the link that I showed in the last slide, this jot form link that's here, people will actually go to that link. There's going to be a brief questionnaire. It's our intake form. And in normal years, when people would visit and come to a VITA site, they would get the paper version of the tax form, or the intake form rather, that is going to be built into jot form. So they're going to get the link, hit the link, go to jot form, and in jot form will be the same form that they would fill out on paper is going to be built into jot form. So they're just going to answer those questions the same as they would in person. And then once they get through that, there's going to be a spot where they can upload their documents. And all they really need to do is take a picture of them with their phone, and they can upload them, or with a tablet or anything like that, and they can upload those documents right into the JotForm platform. Again, our platform is secure. It has protections, it has encryption, all that kind of thing. So the information in there is very, very safe. You don't want to send pictures of you, like don't put selfies and things like that in there. We just want pictures of the documents and the forms that we need. So the things that we're going to be looking for is the same thing that you would bring to an in-person visit. So we are going to need to see social security cards, ID, all of your W-2s, 1099s, any banking related information. If you do want to do direct deposit, we would need bank account information, so you can take a picture of the check. Anything like, I'm trying to think if there's anything else that would be on the top of mind. Unemployment compensation forms. We're going to need for the stimulus payment. There are specific questions in the tax software that are asking about the amounts that people received for the stimulus payment. So if individuals received a stimulus payment this year, just go back. If you don't know it off the top of your head, go back and review it in your bank statement. You can log on to see that, or if you have paper copies of it, and just make sure that you have that exact dollar amount. It is going to ask for that. And then if things need to be reconciled in there, so I'll give you an example for myself. So I received the first part of the stimulus the first time that they sent the check out, but I did not get the second part that they sent out. So when I did my tax return, they actually asked me how much I received, and then the part that I didn't receive, they actually are going to send that to me in my refund when I get it this year. So that's how they're working it out. Now, that being said, your stimulus payment is not taxable. So this is not going to be taxable income to you, but they do need to know how much you received, just in case they owe you any more. Okay. However, if you did receive both payments, you're all set. Okay. So that we will need. If you have health insurance through the marketplace, which is Access Health Connecticut. So if you receive a form from them called a 1095A form, and you'll get it in the mail from them, if that happens, we will need to see that as well. And lastly, if you have been a victim of identity theft and you received in the mail, and you would get a new one every single tax year, an identity theft PIN number. And it comes in a letter from the Internal Revenue Service, and it will be mailed to your house. It's mailed there every single year because they give you a new number. If that's the case, we'll need to see that PIN number too.
Great, that's really helpful. We did have a question in the chat actually about the stimulus checks and
Yes.
how if people didn't get those in the past, how they would get them. I'm wondering if there are any other differences this year because of COVID-19 in the tax filing process.
Any other differences? I mean, I think the primary difference is just how we're offering VITA this year. That's probably the biggest difference. And then certainly the stimulus payments. The only other thing that I can think of that might impact filers for this season is normally if you are doing charitable contributions, cash ones. So for example, if you made a cash contribution, let's say to United Way as an example, if you were to do that in previous years and you were not itemizing your tax return, okay, remember we talked about that early in the presentation, whether you're doing standard deduction or you're doing itemized deductions, right? So in normal tax years, you would only claim the cash donations or charitable contributions if you were itemizing your tax return. For this tax year and this tax year only, the IRS is allowing up to $300 of cash, not furniture and clothing and all that other stuff, cash contributions only, up to $300 that you can include in your tax return if you are doing a standard deduction, which is actually really nice. So that's an extra added bonus there.
Thank you. Another question is, what is the process of paying back the government if VITA determines I will not be eligible for a refund?
So you can do that a couple of different ways. So if you do owe at the end of the day, and you have taxes you have to pay, there's a way that you can print a voucher. So if you come to VITA, the voucher will be printed. It will come out when we do the tax return, and you can use that voucher to actually mail in your payment. You can mail the whole thing at the same time, or you can mail in whatever you can afford, and then the IRS will contact you to sort of set up a payment plan after you do that. What I will say though is that please try to get as much of the payment, if not the whole thing, in prior to the tax due date, which right now is April 15th. I do not have any information or confirmation if they're going to extend tax season as they did last year. They may, but there's no confirmation of that right now. So if you do owe money, do try to get as much, if not the whole thing, in prior to the due date, because what happens is if it gets in after the due date, that's when the penalties and fees and so on and so forth will start. So that would be my one suggestion. You can also do direct debit. So when you do your tax return, there, especially electronically, there is an opportunity to hit direct debit to take that payment out of your bank account. A lot of people do not choose that because it's automatic. It would happen very quickly, and most people want to take the opportunity to wait until the end of tax season to get it in. But you can do that as well. You can select the direct debit if you choose.
Great. That's related to another question. Are there other ways to get your refund besides direct deposit?
Yes, you can get a check. So if you're doing if you don't want to do direct deposit, you can opt to get a paper check. The difference there though is it takes a lot longer to process that. So if you are doing direct deposit, which I highly recommend, if you do it that way, it's going to be within, about 10 to 15 days. Now for this year, I would give the IRS just a little bit of wiggle room on that, because again, they've been processing a heck of a lot with returns. Certainly, tax season starts tomorrow with the IRS accepting returns for this year. So it's going to get real busy really quick for them. And they've been processing all these stimulus payments. So we're going to, be patient with the Internal Revenue Service in terms of processing this year. But generally speaking, if you do direct deposit, it's pretty quick. It's within 10 to 15 days or so. If you're doing a paper check, that's going to look more like 6 to 8 weeks. So you just want to take that into consideration in terms of how long you'd like to wait to get the refund back.
Great. Thank you, Laura. And I think we're nearing the end of our Q&A session. This has been super helpful. I learned a lot, and I'm really happy that we were able to have this great time to ask questions and learn a bit more about tax season this year.
Absolutely.
Anika, do you want to wrap us up?
Sure. So with that, we've reached the end of our Q&A session, but obviously if you have more questions, please feel free to reach out to Jenna or try to contact the village for more information on this specific event. So with the end of our Filing Your Taxes 2021 virtual event with Laura O'Keefe from the village, we've had a lot of great questions. I've also certainly learned a lot, and we want to give a big thank you to Laura for all the helpful information today. Please look into the village to learn more about other programs and services they provide as well. The City of Hartford would really love to hear from all of you as well. If you want to go to the next slide for us, Laura. Thank you. And this is especially the case if you live in the North Hartford Promise Zone area or are part of the Hartford community. Jenna is going to be posting a link to our event survey in the Zoom chat and in the Facebook comments as well. So we just ask that everyone who has attended or is watching the video, please fill out this survey so we can put out more helpful resources and events like this one and to learn more on how to serve the NHPZ better. Please feel free to contact Jenna at jenna.vandonsolar@harvard.gov. It was on the previous slide. And if you're watching back, feel free to go back to the previous slide to learn more about the services that the City of Hartford, the North Hartford Promise Zone, our Envision Center provides. And we look forward to seeing you at our next event, COVID-19 The Facts, on February 18th from 6 to 7 p.m. And as a reminder, we're going to be posting all the links to our social media and to the Eventbrite to sign up for our Zoom later today as well. So good night, everyone, and thanks for attending. Bye.
Thank you so much.